When ordinary people take on Wall Street, the foundations of the stock market can be shaken. In 2021, the GameStop short squeeze wasn't just a financial event. It was a cultural phenomenon that stunned the world and left hedge funds reeling. It all started with GameStop, a struggling video game retailer that seemed destined to fail. Hedge funds were betting big against the company, shorting its stock in hopes of profiting from its downfall. But they didn't anticipate a group of retail investors, united on Reddit, who had other plans. Armed with trading apps like Robinhood, they saw an opportunity to outsmart Wall Street. What followed was a buying frenzy rarely seen in the stock market. GameStop's stock price exploded, rising over 1,700% in just weeks. Hedge funds, caught in a short squeeze, lost billions as they scrambled to cover their positions. It was a David versus Goliath moment that captured global attention, sparking debates about market fairness and the power of retail investors. But the chaos didn't stop there. Trading platforms halted purchases of GameStop shares, triggering outrage and accusations of protecting the big players. The fallout left lasting scars on Wall Street, with calls for tighter regulations and deeper scrutiny of market practices. The 2021 GameStop saga is a stark reminder of how fragile the stock market can be when emotions and internet-fueled movements collide. When trust in the banking system collapses, financial chaos can spread like wildfire. In 1907, the United States faced one of its most severe economic crises, an event that nearly brought the nation's financial system to its knees. The Panic of 1907 began when a failed attempt to corner the market on United Copper Company stocks sent shockwaves through Wall Street. When the scheme unraveled, major banks and trust companies that financed the effort found themselves on the brink of collapse. Panic spread quickly as depositors rushed to withdraw their savings, fearing their money would vanish. Banks couldn't keep up with the demand, and many closed their doors, triggering a domino effect of financial failures. What made this crisis so devastating was the lack of a central bank. The US banking system was fragmented, with no single entity to step in and stabilize the situation. Enter JP Morgan, one of the most powerful financiers of all time. Morgan rallied other bankers to inject capital into failing institutions, buying time and restoring some confidence in the system. The Panic of 1907 exposed the fragility of America's financial system and led to the creation of the Federal Reserve in 1913, providing the country with a central authority to prevent future crises. This financial earthquake remains a stark reminder of how quickly confidence can unravel and how vital safeguards are to a stable economy. When the fuel that powers the global economy is suddenly cut off, chaos can ensue. In 1973, the world plunged into chaos as oil became a weapon, triggering one of the most devastating stock market crashes in history. The crisis began with the Yom Kippur War, which prompted the organization of Arab petroleum exporting countries to impose an oil embargo on nations supporting Israel. Almost overnight, oil prices skyrocketed by 300%, sending shockwaves through economies worldwide. Fuel shortages crippled industries, transportation stalled, and inflation surged, creating a perfect storm of financial devastation. Stock markets around the globe plummeted. In the United States, the Dow Jones Industrial Average lost nearly half its value, erasing billions in wealth. Across Europe and Japan, investors panicked as their markets spiraled downward. The crisis ushered in an era of stagflation, where high inflation and stagnant growth brought economies to their knees. Governments struggled to find solutions, and trust in the global financial system waned. For many, the crash was more than numbers on a chart. It was lost jobs, rising prices, and a new reality of economic vulnerability. The 1973-74 stock market crash serves as a chilling reminder of how geopolitical events can topple even the most stable economies, leaving nations to grapple with the far-reaching consequences. In the late 1980s, Japan's economy seemed unstoppable, with soaring stock markets, skyrocketing real estate prices, and a financial system bursting with confidence. But beneath the glittering surface lay a bubble waiting to explode. And in 1990, it finally burst, unleashing decades of economic stagnation known as the Lost Decades. Fueled by speculative investments and loose monetary policies, Japan's asset prices had spiraled out of control. Land in Tokyo was worth more than the entire real estate value of the United States. Stocks reached dizzying heights, doubling in just a few years. However, when the Bank of Japan raised interest rates to cool the overheating economy, the bubble began to deflate fast. By 1992, Japan's stock market had lost more than half its value, wiping out trillions in wealth. Real estate prices plummeted, leaving investors with properties worth a fraction of what they had paid. Banks, burdened with bad loans, teetered on the brink of collapse, forcing the government to step in with costly bailouts. The burst bubble didn't just dent Japan's economy, it redefined it. Growth slowed to a crawl, and the country struggled to recover for decades. The 1990 crash remains a stark lesson in the dangers of unchecked speculation and the long-lasting damage it can inflict on a nation. In 2015, China's stock market was a symbol of rapid growth and prosperity, with millions of new investors flocking to buy shares in hopes of quick wealth. However, cracks were forming beneath the surface, and when they gave way, the resulting market turbulence sent shockwaves through China and the global economy. Fueled by speculative trading and easy credit, Chinese stocks had surged over 150% in less than a year. The frenzy was driven by retail investors, many with little financial experience, pouring their savings into the market. By mid-2015, prices had become dangerously inflated, and the bubble burst. Over $3 trillion in market value evaporated in just a few weeks. The government intervened aggressively, suspending trading on hundreds of stocks, banning major shareholders from selling, and pouring billions into the market to stabilize it. Despite these measures, volatility persisted, and in early 2016, another market drop triggered the newly implemented circuit breakers, halting trading entirely, only to cause even more panic. The turbulence revealed vulnerabilities in China's financial system, from over-reliance on state intervention to the unchecked growth of margin trading. While the market eventually stabilized, the crisis left a deep impact on investor confidence and raised questions about the sustainability of China's rapid economic growth. The 2015-16 Chinese stock market turmoil was more than a financial hiccup. It was a wake-up call for the world's second-largest economy and a reminder of how fragile even booming markets can be. On October 13, 1989, fear gripped Wall Street as the stock market spiraled into chaos, erasing billions in a single day. In just a few terrifying hours, the Dow Jones Industrial Average plunged nearly 7%. A stark reminder of how quickly financial markets can crumble under pressure. The crash began with shocking news. The highly anticipated leveraged buyout of United Airlines had collapsed. This wasn't just a failed deal, it was a warning sign. Investors panicked, fearing the collapse of one major deal could unravel the web of corporate debt propping up the market. Selling spread like wildfire, and computerized trading systems amplified the chaos, dumping stocks at a dizzying pace. The markets, still scared from the 1987 Black Monday crash, seemed on the verge of another catastrophe. Rising interest rates and growing unease over debt-fueled corporate buyouts added to the frenzy. Traders scrambled to contain the damage, but the sense of control was slipping away. Though the markets eventually recovered, the 1989 mini-crash exposed the fragility of an over-leveraged financial system and the dangers of unchecked speculation. For a brief moment, it felt like history might repeat itself, and that fear still lingers as a haunting reminder of how thin the line between stability and chaos can be. Just imagine the stock market losing nearly $20 billion in a single day, wiping out wealth in the blink of an eye. On May 28, 1962, the United States witnessed one of the scariest market meltdowns in history, an event so swift and chaotic it left Wall Street trembling. The crisis began with rising fear. The market had been shaky for months due to the tension surrounding the Cuban Missile Crisis and growing distrust in the strength of the US economy. Investors were already on edge when, without warning, a tidal wave of selling hit. Panic spread like wildfire as the Dow Jones Industrial Average plunged by 5.7% in a single session, marking one of the largest one-day percentage drops in history. Stock prices collapsed so quickly that brokers couldn't keep up. Phones rang off the hook as investors begged to sell, only to find their orders overwhelmed. Reports of the financial ruin piled up as the sell-off continued, feeding the frenzy and deepening the fear. Even seasoned traders were blindsided, and the financial system felt disturbingly fragile. The crash highlighted the dangers of unchecked speculation and the market's vulnerability to mass hysteria. Though the markets eventually stabilized, the 1962 flash crash left scars. For those who lived through it, the memory of that day remains a chilling reminder of how quickly confidence can evaporate and how devastating the consequences can be. When an entire continent is suffocated by a mountain of debt, disaster looms. In the early 1980s, Latin America teetered on the brink of disaster, as the weight of billions in loans crushed its economies and the fallout reverberated around the world. The 1983 Latin American debt crisis was a nightmare fueled by years of reckless borrowing. By the late 1970s, countries like Mexico, Brazil, and Argentina had borrowed heavily from international banks, believing that their economies would continue to grow rapidly. But when global interest rates spiked in the early 80s, the dream of endless prosperity turned into a nightmare. As the cost of borrowing soared, countries could no longer pay their debts. Mexico was the first to crack, announcing that in August 1982, it couldn't meet its payments. The dominoes fell quickly. Other nations followed, and soon the entire region was in crisis. The banks, which had eagerly lent out money just a few years before, now demanded repayment, but the Latin American economies were already collapsing under the strain. Inflation soared, unemployment skyrocketed, and entire populations were pushed into poverty. Social unrest spread as governments were forced to implement harsh austerity measures, cutting vital services and raising taxes. The crisis left deep scars and decades of economic instability, widespread poverty, and lost opportunities. The 1983 Latin American debt crisis wasn't just a financial disaster, it was a human tragedy. The continent's hopes for growth and prosperity were shattered, and many nations didn't fully recover until the 2000s. The shadow of that crisis still looms over Latin America today. Which stock market crash story impacted you the most? Share your thoughts in the comments below, and let us know if you'd like to see a part 2 exploring more stock market crashes. Join us next time as we delve deeper into the events that have shaped our financial world, because every stock market crash has a story worth telling.